was, relegated to be a structurally broken asset class back during the COVID times. And really, if you go back in time, I think it was three reasons for that. One was obviously the lockdown that we all experienced. There were some structural changes in the way consumers were consuming and buying goods. And then, finally, there were some high-profile bankruptcies that we all experienced during that time. Coming back to today, clearly retail is one of the tightest asset classes in the country today. And so the question really is whether retail is relevant or is broken. The question is, what did we get wrong? And I'm going to start with Martha first. So Martha, what do you think the pundits got right, and what do you think that they got wrong during that time?
Yeah, sure. So pundits are pundits. I think they sensationalized and were non-specific in sort of the coverage of the retail disruptions, right? There have been major disruptions to the retail space over the last 20 years, really. You had, an oversupply of retail coming into the GFC. You had sort of rapid inflection in e-commerce penetration in the 2010s. You obviously had the COVID shock, which was highly disruptive to retail. So those truly were disruptive moments for retail. But I think the pundits, and more importantly for this conversation, the capital markets, really didn't differentiate between how those different events impacted specific assets, right? Assets perform differently depending on a lot of different things. You have market implications, different markets perform differently. You have tenancy, right? Certain assets with certain types of tenants were more resilient in this than others. And then you had format, right? You have open air format, grocery anchored or not, necessity based or not, power, mall. All of those factors are really important. And so you have had retail go through disruptive moments, but not all retail assets have suffered in the same way. And actually coming out of COVID, we saw a lot of really positive fundamentals in the space. At least in the open air space, you saw real occupancy gains, you saw real rent growth, you saw real NOI growth, in some of the better markets and really across the US in the open air format. And so, yes, retail has struggled and was sort of an out of favor asset class for the last decade. But honestly, we at Bain Capital saw that dislocation. We saw that it was out of favor and that the pundits and really the capital markets were sort of throwing the baby out with the bathwater and not really differentiating between, among assets. And we decided that was the time to jump in because we liked that dislocation. A couple other things I think they sort of understood but didn't quite get the nuance of. Is e-commerce penetration, right? Like we all see that e-commerce is continuing to penetrate. It's sort of capping out in the high 20s to 30% in terms of percentage of overall consumption. But what I think the pundits missed or didn't get up to speed on quite as fast as they should have is like omnichannel is the preferred modality, both for consumers, and for retailers alike. Yes, I like buying, Lululemon pants online. Of course I do. But I also like returning them when they don't fit in the store because it's easier for me. It's easier for me to go do that errand when I'm going to Whole Foods or going to Starbucks versus, getting myself to a UPS store, which invariably is like open for 2 hours during the weekday, And so I think they misunderstood that that modality of omnichannel was important for the consumer and for the retailer, right? We at Bain Capital own a lot of retailers, and it's a cheaper customer acquisition tool, honestly, to use a physical retail box to acquire and service a customer than it is necessarily to use 100% retail online channels. And so this omni-channel modality, as long as we're a consumption economy and consumption is continuing to grow, and the US is a consumption-driven economy, I think that retail should withstand some continued penetration online. And then very lastly, I would say, this idea that bankruptcies, retailers go bankrupt. Of course they do, right? Like
it's the nature of it.
It's the nature of it.
Every February, you got your filings, right?
Yeah, and you look. I mean, the public
and
the public REITs suffer because they all have exposure, and so invariably there's a specter of some bankruptcies every single year. But at Bain Capital, we have been investing in retail businesses for 40 years. And so we are much more focused on figuring out where the puck is going in retail and not necessarily worried about which companies are going bankrupt in any given year. I mean, companies have to change and adapt, as consumer preferences change. And the ones that don't get up to speed and change their formats and change their business models, they're not going to survive for 20, 30, 40 years, and that's okay. You have new businesses form, and that's fine. And as an owner of retail, you just have to be prepared for that and understand in your book, okay, do I have exposure to tenants that are risky? Have I adequately maintained capital reserves so that I can re-tenant those spaces? And so, for us, it's less of a dramatic event when companies go bankrupt in this space.
Very well said. So maybe, Kevin, I'll ask you the same question with a little bit of the bent, because there's a lot of focus on Gen Z during COVID and their consumer preferences. I mean, we've read articles, Gen Z is never returning to a store. You have access to a lot of data. What does the data really tell you about Gen Zs?
Look, the data tells you that Gen Z is the same as the boomers, as X, as millennials, right? They go to the store, they like to shop, they like to hang out with their friends. I have 13-year-old and 11-year-olds, and they do like to go to the mall and, go have lunch or go to the movies or go play mini golf and come home with a Hollister or Abercrombie hoodie, right? Like, they like to go to the mall, but that's no different than any other generation, right? And this is where I think the pundits were wrong. Like, the pundits didn't understand the consumer in 2016. They just assumed everybody was going to shop at home, but people don't like to stay at home all the time. We learned that in COVID, right? And it took COVID for people to fully realize that. And then the retailers misunderstood that too, right? Like, they all wanted to compete with one-day delivery and Prime-like delivery with Amazon. Amazon's not a retailer, it's a logistics business. It's actually the worst retailer in the United States. If you've ever gone into any store that Amazon has put on, it's a terrible experience. And if Amazon people are in the room, I apologize, but they are the best logistics business in the world and the best marketplace in the world, but a terrible retailer. And that's because that's the nature of who they are, right? And they don't make money on their website, they make money on their AWS. And retailers couldn't chase that race to the bottom, right? Like, when you're the best logistics business in the world, you have economies of scale. A retailer can't meet that. Where can a retailer meet that? In e-com and buy online, pick up in store, and return to store. And everybody learned that from the winners and the losers in COVID. Like, in those years, the Targets, the Walmarts, the Dick's Sporting Goods all won because people didn't have to go into the store to get what they needed, whether it was groceries or a t-shirt or athleisure, where, Dick's Sporting Goods was really winning, right? And so, coming out of COVID, I think everybody realized people like to do things, right? And customers like to do things. And, as they start to focus on Gen Z, who's gaining in wealth and gaining in buying power, well, what does that generation want? That generation wants to go places, whether you're 13 or mid to late 20s. They invariably like to be on social media, and they want to be part of a community. They want to post. They want to say, this is who I identify with. I'm in Alo, I'm in Viore, I'm in Abercrombie, I'm in American Eagle, I'm in any one of these particular places. How are you facilitating that community, that identity with that generation, right? So it is omni-channel, it is distribution points, it is catering to these customers, and we as landlords need to help facilitate that, right? They don't want to go to, your 1970s mall with 4 department stores and an orange Julius, right? Like, they want to go to a place that's, fun and interesting, and they can hang out with their friends and do things and shop and take pictures. And sometimes they don't actually buy the thing. Sometimes, they go on their phone and they buy it somewhere else, and that's okay. We as the landlords need to figure out how we can capture that sale in our rent. It's tough right now to do that because there's no way of reporting it. The retailers know the value of that store. We know the value of the store, but it's all numerically based stuff. And so, that's sort of part of the future of it. But the customer is there, when the mall opens to walk, and the customer is there and on the weekends with the Gen Zers.
That's great. So I'm going to switch topics to platforms. You both have substantial platforms that you've built, and retail is a nuanced asset class. We'll all agree with that. There's a lot of opportunity for value creation, but platform plays a very important role. So maybe, Kevin, I'll start with you first. Brookfield and the broader platform you have, which is a global machine, how are you leveraging Brookfield for the benefit of your retail platform that you oversee and run?
I'd say it's actually a two-way street, right? Inside GGP, how do we benefit from the broader Brookfield platform? You know, we want to build multifamily, you know, in San Francisco or whatnot. We have lots of land, and how do we execute on that? How do we underwrite that? We've got a great housing team that can underwrite any type of housing sector that we may want to put there. We have a hotel team that can underwrite hotels. We have an office team that we're not going to build office right now in suburbia, but if that market comes back, we have people to do that, and we have that all over the country, right? We have, 100 assets that touch in 1 hour drive of 65% of the US population, right? Like, we have an ability to do lots of things. So we leverage that platform when we're trying to do that. We've got banking relationships that are much broader because of the entire Brookfield ecosystem. But it is a two-way street, right? We bought an asset in Paris on the Champs-Elysees. We bought it for $600 million. We sold it for $1 billion to a very large retailer, you know, because we had the relationships to facilitate that discussion. You know, we bought another asset in Paris because we're able to underwrite and make sure that they understand what it means to buy a department store, redevelop it, re-tenant it. We bought a bunch of open-air retail parks in the UK because a lot of those tenants are tenants here, and we understand what it means to lease that up, right? And so that two-way street across the Brookfield ecosystem, which is meant to be in every business we own, is able to leverage that expertise.
That's great. And then Martha, some similarities with Bain and 11 North, a larger platform, and then your retail platform within it. Maybe how's your platform similar? Do you agree with Kevin on how you leverage the platform, the retail platform with the broader Bain platform? Just maybe give us your views and how
Yeah.
you're differentiating in the marketplace.
Yeah, sure. And just to take a step back, Bain Capital Real Estate, really only invests in strategies where two things are true, right? You have long-term, enduring secular sort of thematics behind the investment strategy, and we have, sort of a captive team that gives us access to high-quality deal flow and then, operating capabilities, right? And so we're highly focused on those two things. We need to get the themes right, and we need to have an operating edge, and we think that's really important. And so when we started to study retail, really back in 23, we decided, we were ready to get into the sector. We saw the dislocation I talked about, which is capital markets were throwing everything out. There, you could buy really good high-quality assets at interesting yields. And we decided that, we needed to build an operating business that could go, take advantage of that theme. We ended up meeting with someone named Brian Harper, who I'm sure many of you know. He had been running RPT Realty, a public REIT, and when he sold that business to Kimco, we took, with Brian and with several of his teammates, one of whom is here today, we formed a company called 11 North Partners, and that business is a co-owned business between Bain and Brian and the team, and that's our operating platform that gives us competitive advantage, us being Bain Capital, in the retail space. And so we're very, very focused on the platform, and we do think that you have to really have operating capabilities to drive yield and to drive value improvements at your assets.
And in retail specifically, for those of us, and I assume you've worked across many asset classes over the course of our careers, retail is so much more nuanced in needing that operating expertise and
Yes.
really needing those. It's such a relationship-driven business, and those direct relationship with retailers, whether it's grocers on the grocery side, big box power or mall-type tenants, right? Knowing all of them is truly the advantage of being able to, buy something, right? And you need that operating capability. You can't just go in and invest if you really don't know what you're getting into.
That's a good segue, Kevin, because I'm showing on the screen for both 11 North and GGP some of the platforms that you've invested in, the broader organization. So taking your cue a bit on tenant relationships, I agree, it is a differentiator. The question I'd ask is, how do you layer tenant relationships and really tenant underwriting, because it's important to get that right, into your investment philosophy? And maybe talk about, just given GGP's purview, maybe talk a little bit about fashion brands, et cetera, a little bit more. Because I think people will be curious how tenant relationships work behind the scenes.
You know, look, they're deep, particularly when you have, 80 stores with anyone, and there are retailers that do hundreds of millions of dollars of sales, in our assets. So these relationships run for decades, and are extremely, extremely important to both businesses. We don't call them tenants. This was an adjustment I had to make when I stepped into this business. I kept saying tenant, and everybody kept saying partner. The retailers call you their partner. Every leasing person in GGP calls them partners, and it's taken me, I had to psychologically start saying it even though I don't believe it, because it's not as symbiotic. It's a constant negotiation on rent, and how much money they're making versus what their margin is. Look, you see the list of tenants here. Authentic is more of an IP co, but their underlying brands represent, the top 10 tenants of ours. So we have a clear picture of how these tenants, approach negotiations, approach, their store footprint, right? And the deeper the relationship with these tenants, the more you understand what their growth profile is, where they're looking, where they see their customer going. We know exactly how much CapEx they have to spend next year on their store growth, right? You can't just go and say, hey, I'm going to go and buy this asset in XYZ metro area because the demographics are great. You may not be able to lease to 8 of those tenants because their CapEx profile is taken up for the next 2 years, right? And so you're looking at a 3-year forward potential lease to that tenant, and then you got to go somewhere else. But it is very helpful, right? You know where they're going, right? And you have these ongoing conversations. Where do you want to be? Where do you want to go? And then you can tailor your investment strategy a bit to that, particularly around the fashion brands, right? You need to curate around, fashion, and when you get fashion, then you can get food, and then you can get entertainment, right? It sort of builds on each other, the whole curation strategy of it all, right? And do we want to build more retail on top of the retail centers we already have? Where's the demand? Where do we know that's coming from? We get the inbounds from tenants. Where do they want to be? What are the markets they want to be in? So that's how it's very helpful for us. And these brands, some of them have done extremely well. Brooks is killing it. Danny Meyer is an amazing hospitality chairman and CEO. It's great, but there are duds when you invest into retail as well. We bought into Forever 21. Forever 21 filed for bankruptcy, right? Like, it is the nature of February to do that. But when you're in this game, you just know there's always going to be a handful, and we all know it's coming, right? Like, we look at the financials, we see the sales, we know it's coming. You're planning for it, right? I knew Francesca was going to file 18 months ago, right? And so we had been trying to back lease off of that happening, knowing a bunch of those stores are going to get rejected. Like, Eddie Bauer filed. We happen to own Eddie Bauer and Catalyst, so I knew that was happening. So we were planning on backfilling those anyway, right? So, you know what's going to happen well in advance, and you know who's having problems and who's having issues. They're usually asking for rent rebates to try and save themselves, and then you just start getting ready to backfill.
Very interesting. Martha,
Yeah.
same question, but...
Yeah, we have a really similar experience. I mean, you see up on screen, Bain Capital has owned many, many, many retailers over the last 40 years, right? We have a large-scale, private equity business that invests in these companies.
Right.
And so, our portfolio is sort of the top ones today, but we've owned everything from Domino's to Burger King to Dunkin' Donuts and Staples and Michaels and all the rest. What we do today with this information is a couple things. We've built a proprietary tenant scoring, asset scoring model that incorporates a myriad of variables to score any given asset that we're underwriting, but one of those is a tenant score. And what that tenant score is we've gone through and basically given scores to about 500 to 700 regional and national businesses, tenants or partners, potential partners, brands, retail companies, based on the proprietary knowledge that we have, we meaning Bain Capital and our partners, 11 North, of those companies. How resilient are they? What are their business models? Are they growing? Are they shrinking? Like, everything we know about them, we put into a model. And so when we go out and underwrite an asset, a lot of buyers say, okay, well, what's the percentage of ABR coming from grocer? And, how many credit tenants are there in there? And that's fine and good. But we go a layer deeper, and yes, we look at those things, but really we're also scoring based on, our proprietary knowledge of these companies, how these tenants are. So you could look at two different centers and we might have a really, constructive view on one because people might say, oh, well, it's only 10% of ABR from gross or something. And we're like, but these tenants are great. And these are next gen, retailers that are really going to drive strong foot traffic and strong performance. And so we certainly, sort of similar to GGP and Brookfield, we really benefit from that sort of platform knowledge that we have. The other thing, to mention is, the tenant relationships are critical. I mean, we can probably reach the CEO of any major retailer within 1 or 2 calls. And that's really important in your upfront underwriting, right? A lot of times we're looking at deals where there's moving pieces and you really have to, underwrite dynamically based on information you're trying to get.
Right.
And if we can reach decision makers quickly, that's very important. And then of course, as we own assets, like you're talking to tenants all the time and talking to the decision makers and reaching them quickly and being partners is really important. And so I think us and Brookfield GGP are really similar in that way.
The relationships is key because it is symbiotic, and if there's a cuspy deal and we need it,
Right.
you make a phone call to the right person and you say, I need this here, they will invariably do it. It's not 100%, it would have to be really bad, but I had to make a phone call for another part of our business that was looking for a very specific tenant that was the right fit. The tenant is going to crush it, but it was cuspy on their own math. And ultimately, they said no. Then somebody called me. I called the CEO, and they said, all right, this is what we need to make it work, and that worked with our underwriting, and we were able to do the deal, right? So those relationships really, really matter once you build critical scale, like they become more important.
Yes.
So I'll take the reverse view a bit, and whoever wants to go first. In this environment, are there any categories or tenant types broadly that scare you today?
Scare me. I don't know if you have
I'll go
anything
first.
offhand.
I will be very obvious with this answer. I am a little bit scared of movie theaters.
God, yeah.
Not excited to buy a movie theater. I think it's a declining business. We all know that. Really, and sort of large format department stores that have not evolved their business models to be relevant in today's environment. Those are scary, and I think the through line for both is like obviously sort of a obsolescence of use in that box, and then a really, really high cost to re-tenant, right? CapEx needs for both of those
You
would
have
be
to underwrite
quite
that.
high.
If you're going in with a box, and look, we have lots of boxes, so we all the CEOs, we all know each other, right? If Dillard's runs really, really, really well, Saks less so. And you see that Saks should be better, but they're going to shrink their footprint, and it'll be fine. But if you go in and you buy something with 2, 3, or 4 boxes, truly big boxes, you have to underwrite at least one of them, probably 2, leaving and redeveloping that. And as long as you have that in your underwriting, you're fine, and that CapEx reserved. Similar to a movie theater, right? I worry less about a box because I always look at that more as opportunity to do something interesting, because that's where all the interesting redevelopments in sort of large format retail, whether it's shopping center or mall type shopping centers or malls. Movie theaters are more scary because you have to take the whole thing down because it's just bespoke to a movie theater.
So it's very dependent on the type, where it is, and who's
I mean,
in it.
location is everything, right? You don't want to buy, look, this goes back to your original comment when on the first question, that where people got wrong, and this is how I read into it. There's good real estate and there's bad real estate. At the end of the day, it doesn't matter if it's retail or office or logistics or whatever, there's just good real estate that people are going to want to go to, people are going to want to work at, people are going to want to deliver from, and you just don't want to buy bad retail because you're dead, right? You cannot change consumer behavior. In our experience anyway. And so you don't want to get into that cycle of just, endless capital trying to change where consumers go. Like we have a history of 70 years at GGP of, trying to do that, not doing that, and where it's successful and where it's not. So we have all those lessons learned. Like you can't change consumer behavior. People like to shop at particular places, and you invest into those places to make them better. Don't try and make them go somewhere else because that is extremely hard.
Excellent. So I'm going to switch to fundraising a bit. And Brian mentioned it during his opening remarks. Congratulations on a very successful capital raise that you recently concluded with 11 North and Bain combined, $1.6 billion. So take us behind the scenes on some of those LP conversations.
Yeah,
I think
sure.
people would be curious. What were they saying?
Sure.
What were the reactions?
Yeah, thanks. Yes, we are very pleased to have announced at the end of last year a successful fundraise. Always, good to end the year that way. We had, at the outset of forming 11 North Partners, our goal, our plan was to always do a Core Plus fundraise. We have a value-add commingled fund at Bain Capital, and we would, use 11 North as the operating platform to go prosecute deals for that fund. But we were also planning to do a Core Plus fundraise. We actually saw a dearth of capital in the Core Plus space for retail, and so we wanted to raise a vehicle. And from a timeline perspective, we launched 11 North in 2024 and really started those conversations right away. And we closed our fundraise at the end of 25. So let's call it 2 years, plus or minus. We've been talking to LPs for 2 years. And I think that the evolution was really interesting at the beginning. And so for that first year, we had a lot of LP conversations that were educational, right? It was retail's kind of on our mind, and but it's kind of on the queue, and we're thinking through the thesis. And can you educate me? Can you walk me through what you're thinking about or what you're seeing? As our investment committees are doing thesis formulation and figuring out where we want to deploy capital. That was a lot of the first year, with the exception of one of our major LPs who was heavily convicted the whole time and is still convicted and was there from the beginning.
Right.
For the rest of the LP base, I think that really there was sort of a fast transformation from, hey, educate me, please, because I'm getting up to speed and either trying to re-enter the space or enter the space, anew. And so that all happened in 24-ish. But by the second year, it had changed really fast. We had really good conversations that were setting the stage. People, went through their thesis ICs and all of that. And by early 25, we were getting phone calls saying, okay, we're ready to go. Retail is one of our highest conviction strategies, and we want to get a platform. We want to get exposure to the space really quickly. And so we saw a shift quickly, and I think those of who, you in the audience who are, participating in this sector and, have seen the capital market shift really fast. I mean, cap rates have compressed, and I think that's because really quickly you have gotten, folks, whether they're on the large LP side or funds or, private equity funds, et cetera, you've had people really form thesis quickly and then start to buy assets. And so, that was interesting. The other thing that I would highlight as interesting is, like us, the LPs see this as a national strategy. Or said differently, I was surprised that LPs were not focused on, we only buy coastal, we only buy core markets, highly specific about what this strategy could be for them. Because, oftentimes, there's some geographic overlay or something that really makes the buy box more specific. And I think, like us, the LPs realize that, retail is hyper-local, and there's good assets everywhere. And so, one of the first assets we bought was in Oklahoma City. We bought a 3-pack of dual-anchor, grocery-anchored lifestyle centers. Really high quality, N-of-1 type assets, probably the best asset in that market. If you had asked me and the LPs, is Oklahoma City on your list, and is it high on your list when we originally set out the thesis? Probably not. But I think as you study the information, the data, and you see the sales performance coming out of some of these tenants, and you look at the 3-mile, incomes and demos, like they stand out. And so you can see that, across the US, there are nodes where retail does very, very well. And so I was surprised that, we had sort of formed that thesis, and we have a view on sort of, market quality versus asset quality, but that the LPs believe that too, and that there's good retail everywhere. You do have to be thoughtful about liquidity, obviously considerations in some smaller markets, but if you see the sales performance, I think it's really, really interesting.
Well, there are a couple of assets that have traded in Omaha and Tulsa as well at much tighter cap rates than I think anybody thought they would have, in the last 6 months, which we were pretty surprised. We look at everything. I'm sure you look at everything. You saw it, and I was shocked. But, they're good assets. They're strong assets in good markets, right,
But the one in Omaha, I mean, we have a data scientist who, has mapped the U.S. in quarter mile by quarter mile little gradients, and we input a whole bunch of data into that. And you know what? The asset that they bought in Omaha is in the exact micro location that you would want to buy.
It's where the whole city's growing.
No,
we've got
screen on the screen.
We've got an asset in Omaha, so we were looking at it to see if it made sense and see if there were synergies and whatnot. But that's where the city was. The city's moving that way, and it'll be a good buy for them.
Totally, yeah.
Right. So, Kevin, you rolled out a rebranding.
That was the picture they gave you. We did.
So you rolled out a new name, which is the old name.
Yeah.
So that's
What's
sort of
old
the joke.
is new again. It's retro.
Exactly, the old is new. Maybe just walk through the branding because it obviously got a lot of press and
Yeah.
some people were interested to see why the name, why go back to the roots.
So look, Brookfield, I've been at Brookfield for a long time. What we had done for, a lot of years was we'd buy these platforms and we'd rebrand them and put them under, call it our Brookfield Properties umbrella, which has historically been the name of our real estate operating businesses.
Yeah.
Brookfield Properties Retail, Brookfield Properties Office, and so on. And I think what we've realized over the last number of years, and we've bought other companies that have their own unique identity, is it does make sense for these businesses, particularly a business of GGP scale and fully integrated model, of having their own identity to the market and showing themselves to the market in a particular way, whether that's tenants or lenders or investors, right? We have our own investors in GGP that some of whom Brookfield bought, some of whom have been in the business for 30 years,
Yeah.
right? And so holding yourself out that way, creates a differentiated brand identity while being completely part of Brookfield, right? Like it's completely integrated, but it has its own sort of brand identity, its own, employee brand identity. People buy into it a little bit more when they know they're part of this big thing. And so, when we started the conversations about this, what should the name be? There were lots of voices, but we kept coming back to GGP, and there are a number of reasons why. There's brand history, brand integrity. The lenders still called it that. The tenants still called it that. Everybody still called it that. And so, Michelle, who's in that picture, who's our chief marketing officer, we spent a lot of time going back and forth on this and why would we go back in time, go forward in time, maybe we should do something new. And ultimately we realized when you're in retail, brand matters, right? And so what was that sort of brand value was tremendous. And then at the end of the day, I started at Brookfield in 2010, and the first thing I worked on was our investment into GGP to have it emerge from bankruptcy, right? So sort of full cycle. But from that day forward, even when we rebranded it, from Bruce Flatt to Brian Kingston on down, nobody called it anything but GGP. Like literally nobody has called it internally anything but GGP, except the people that are in GGP. They called it Brookfield, but like all the Brookfield people that are top called it GGP. And so I said to our head of marketing, I said, Michelle, you want me to give this a different name? Bruce still calls it GGP. Like I can't ask Bruce to not call it GGP. It's always going to be GGP. Like that tells you something, right? And so, then we came up. We went, then it became a discussion on fonts and greens and all of these things that are well beyond my knowledge or expertise, we'll say. But the team did a great job on rollout and timing and strategy. And nobody in the business knew, but for like 6 people until January 5th.
That's right. It's a storied past, right? It's a long dated history. So I know we're low on time, but I'm going to ask a question because we've talked a lot about COVID era and what really transpired, bucking the trends. So maybe let's go forward in time, 2031. If we're sitting back here again in 2031 in this panel, what do you think we will say we got wrong in 26? I know it's a curveball question maybe, but maybe think about what.
I can say I'll do one positive and one negative. So I think we will be surprised to the upside on rent growth, at least in the next few years, at least in the sort of format that I invest in, which is open air. And this is for a couple reasons. One, supply pipelines are still really muted. If you think about, how much rents would need to increase to justify the cost to build, we think it's 25 to 40%, depending. And so, I do think that you'll have some runway as it relates to sort of the supply-demand imbalance. Centers are full, space is not that available. Vacant space is not available, and you don't have that much supply. So I think you'll have some durable rent growth. I also think, candidly, the adaptation of technology and AI tools at the retailers should drive some productivity gains. And the landlord should be able to take advantage of, some of that as sort of rent increases. So we don't underwrite it. I'm looking at Hannah over there. We don't necessarily underwrite really strong rent growth. I mean, we do a granular analysis, but I think we could be surprised to the upside on rent growth, and even in boxes, because I think there is a lack of available space, and the box tenants, really do need it, the ones that I think are viable tenants. To the sort of potential negative, I mean, overall, we probably are vastly underestimating or missing, the overall impact of AI on the economy and on the consumer economy, right? I mean, I think, depending on how quickly you have the replacement of white-collar jobs with agentic AI tools, you could have a major disruption in consumer spending in the U.S. And if that's a long period of time, that it sort of takes a while to work through, and there's enough time and space for new, businesses to form and for sort of the loss of jobs to be absorbed somewhere else, it could be okay. But there's certainly a world, and I'm sure we're all reading, the same articles and listening to the same podcast, but I'm sure there's a world in which, sooner than we hope, there's some pressure on the consumer spending.
Yeah, I'd say I worry. I mean, look, I worry about it because I have kids, but I worry less about mass unemployment while we don't have enough power or a power grid that can power, like terminating all the lawyers and all the investment bankers and all of us, and we can't have these conferences. I just don't worry about it because, you can't power the data centers necessary to do that, but it is a risk. I do wonder whether it's a 5-year or a 10-year, what things like agentic shopping are going to be, where you have AI pick and choose what you're wearing, and then how do you foster that in assets? Is it a much more technology enabled customer experience where they're looking at screens and the clothes are literally virtually coming on and off them, and they don't actually need to have inventory, so the retailers need less space? It's those kinds of things that are percolating in my head about what is our strategy going forward and how is this going to impact it, and how can we, meet the market, right? And how can we, take our existing portfolio and make sure that, we're investing in it the right way to foster that, as well as make the right future investments in new assets that are going to be at the front foot with what AI is going to do, right? It's a real thing. It's really out there. I don't know if we're going to, there's going to be mass unemployment, across sort of white-collar jobs or not. There will be some impact over the next sort of 5 years. How material that is, we'll see. Certain materiality is going to impact consumer spend, and maybe that means we're all leaning more into value brands, as we cycle down, right? JCPenney's is coming back. So
That's great. Take it in strides, right? And then I'm going to tell all the bankers and brokers we're going to up our rent growth forecast, as Bain told us to.
Well, then we'll dial it back anyway, so it's fine.
Great. I don't know. I think we may be short on time, but maybe a minute for one question, unless Goodwin thinks we have more time. We don't. Okay. I guess not. We've been shut down. Well, thank you, everybody. Enjoyed the conversation, and hopefully you did too.